Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of the Chicago soybean complex.
Chicago soybeans. 4 weeks ago, we had the true break below the lower bull channel line of the second bull channel, which is highlighted in bright red on my daily chart. That same week, we had the break confirmed with a break below the declining long moving average, currently 1458. It was the total finish of the bullish incentive that started back from the break up and out of the late 2022 ascending triangle in November last year. I asked a question 3 weeks ago and also postulated some possible answers at the same time. Thus, and I quote, "The question now is what will be next." Now, you may say that all this action since last October is part of an ascending inverted scallop pattern, or you may say it's part of a bump and run reversal top pattern. And in both cases, I'd agree there are elements of both of those patterns here, but not enough to say it's one or the other. Hence, I choose to look at the longer term charts to see if I could gain a clue as to what will be next, end of quote. Now, looking at these longer term charts provoked the following comments, and I quote, "The possibility that we now had a February 2021 to date bear flag. This has set up the opportunity. It will very much depend on two factors," end of quote. I then turned my gaze at the more recent action and I expanded on this point, and I quote, "Will the market halt at the congestion at 1378 that formed the lower trend line of the descending triangle from late last year? And if not, will it halt at the July 2022 low at 1304? If the answer is no to both, then we may well have a bear flag formation with potential down as far as the 1120 zone. Quite a big move if it does come about." And that's the end of the quotes. Well, 2 weeks ago, the market indicated that it was not happy with this bearish idea, at least not now, by making a strong bullish harami, bouncing up off the 1378 support. This move back up accelerated within a fairly free area, reaching the 50% Fibonacci line of December 2020 to February 22 move at 1451. Where they hesitated for a bit before punching up through the long moving average, currently 1458, then the medium moving average, currently 1488, and finally halting early last week at the declining short medium moving average, currently 1493. Since then, prices have edged back down, but only as far as the long moving average, where they have seemingly gathered some ammunition for another attempt higher this week. The immediate question now is whether the market will utilize this move up and the action since late March to make a double top, ultimately a bearish pattern, or will it make a possible bullish halfway hesitation? It's too early to say if it's a double top, but an idea, not a target you understand, but an idea for a bullish halfway hesitation would be up in the 1570 area, close to the November 2012 high at 1571. If this was to happen, then keep a wary eye on the short medium moving average plus the 2014 high at 1522, and above all else, the 50% Fibonacci line of 1532 of the February 22 to July 22 move. One final note, again, it is a repeat of something I've cautioned on last week. I'm not a follower of Gartley analysis, mainly because I've not had time to study it properly. However, I'm minded to look at the action from July 22 to date as having elements of a possible Gartley butterfly pattern. I'll just leave that bit with you to finish off this part. Chicago soybean meal. Despite the recent action, I feel obliged to start this commentary once again noting that we had a monthly key reversal down here last month. Now, I'm sorry, I know I'm repeating here myself yet again, but the situation deserves repetition. You see, for months now, we've had different patterns, not so much melding in with each other, but rather crashing in and out of each other. The bigger pattern here is the May to date, seemingly broken, then repaired, ascending, expanding wedge pattern. A huge pattern that I pointed out many months ago. This had developed for a while, but is now looking particularly ill. It was never a perfect pattern by any means, but it had seemed to work until the end of last year. To assist in seeing this pattern, I've highlighted it in dark blue on my daily chart. It is worth noting that the lower trend line is also the neckline of the huge December 2021 to June 2022 head and shoulders continuation pattern, currently at 420.60. I'm still thinking about downgrading it as there's enough else going on nearby that deserves some closer and better attention. The next patterns to look at are the ones that caused the peak of the market in early and late December last year. There's a combination of the 2021 high at 471.40, inflamed. Yes, I think that's still a good word to describe it. Inflamed by the neckline, which I've highlighted in bright red, for the February to April 2022 head and shoulders top, currently 483.40. I should perhaps clarify that the June 2014 high at 479.30 had also helped in this matter. The decline we've seen during March started from an attempt to move up and away from this neckline right at the beginning of March. However, fresh resistances such as the 22 high at 491.5 and the 2014 high at 494.40 capped this rise. The market breached both of these resistances but was not able to break them and fell away in the middle of March. The move down was enough to, as I said earlier, create a monthly key reversal down for March. The base of the fall, where it finally stopped, was the rising long moving average, currently 439.10. We have since that base was formed seen attempts higher that petered out against, of all things, the short moving average, currently at 451.40 last week. Prices dropped last week, though, through the medium moving average, currently 459.50, but fell short of testing the combination of the long moving average and the April 2021 high of 439.30. I suspect that these two working together may now be a new higher base of action. This new proposed base has caused the latest move higher this week. We've punched up through the medium moving average and are now heading towards the next resistance levels, which is the flatlining short medium moving average, currently 467.70, and the 2021 high at 471.40. Now, last week I thought that perhaps we might be forming a trading range between the long and medium moving averages. However, that was not to be. So what is the next potential pattern likely to be for the action of this year so far? Well, there is the opportunity to look at the whole December 2022 to date action as a possible diamond pattern. It is a bit of a stretch, and I can easily see it being finessed or even discarded and retired, but the opportunity for such a pattern exists. You can see the outline on my daily chart, but I've not highlighted it as yet because it is too early. Chicago soybean oil. The weekly key reversal down we saw 3 weeks ago is, to put it politely, disappointing. The bullish reaction back upwards starting on a Friday towards the end of March, almost but not quite, managed to reach up to the top of the weekly key reversals range before stalling and falling lower. The cap was the September 2012 high at 57.64, assisted by the congestion between 58.16 and 58.82 that contains the August 2011 high at 58.59. The decline we have seen last week and this should not in any way be regarded as confirming the weekly key reversal down. We are still within that week's range, and until we see prices punch down through the March 2013 high at 51.26, then it will still be an unimpressive piece of action. However, 3 weeks ago, I looked at the longer term charts, longer term picture, and this still has opportunities on the downside. I said at the time, and I quote, looking at the longer term chart, we can see a topping action in formation, though whether it's a lopsided head and shoulders top or a lopsided diamond pattern is still a little open. What we can see is that the 51.10 to 51.20 area is key because of the low from December 2021. Below that, we seem to have a fairly free area until the 50% absolute Fibonacci line at 43.82. End of quote. Thus, it still seems as if we are in a possible bearish trajectory, and this ties in with two possible patterns that you can see right now. A major pattern and a smaller, I won't call it minor, a smaller, because it isn't a minor pattern, a smaller pattern. The major pattern is a late November 22 to date descending wedge pattern, currently at 57.27 to 49.93. We are currently working our way down this pattern. Apart from this work, there is no indication whether it will be a bullish or bearish break away from this pattern. It's still too early. This pattern is highlighted on my daily chart in purple. The second pattern, smaller pattern, is a February to date bear channel, currently 55.67 to 48.20. This pattern seems to be more acutely bearish and is also early on, plus it is formed from part of the larger descending wedge pattern. Once again, there is no indication on whether the breakout will be other than the overall acute bearish angle of the channel. Right now we are testing the February 2013 high at 54.15. Mainly as support, though with today's move lower it may be now as resistance. Until these two patterns are broken, they will show the overall seemingly bearish, larger angle of attack of this market.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.